My name is Michael Guyad, publisher of the Lead Lag Report. Joining me for the hour is David Bastian, the man behind Kingdom Capital. So, David, introduce yourself to the audience. Who are you? What's your background? How'd you get interested involved in markets? And why do you like the pain of small cap?
Well, that's certainly a good question, given how bad tech has been beating up the Russell so far this year. So my name is David Bastian. I founded Kingdom Capital in January of 2022. So we've been open for about a year and a half. We're a small and micro cap focused fund trying to find value in some of the more hidden corners of the market. Prior to that, I was working in private equity due diligence. I started realizing that I could probably do a lot more for myself in the market than I could working on helping large private equity funds make money. So I decided to strike out on my own, and so far so good.
I feel like we need to properly define micro cap and small cap. It's not the numbers of old.
I don't really have a size I'm not willing to look at on the downside. And I don't try to constrain myself to anything, 2 billion or so is about as high as I generally look, maybe 5, depending on the situation in terms of small cap size. My goal is mostly to find stuff that isn't the center of discussion in a given moment. So I think the more people are looking at an idea, the less chance you have to really find something that no one else has discovered. So the less popular, the better, as far as I'm concerned.
So you mentioned the private equity due diligence side of things. Talk through to the audience how private equity due diligence is different from public equity and where the overlap is.
Sure. So it's not a very much of a trading perspective. You're looking at these businesses and consider owning them for a period of 3 to 5 years, most cases as a private equity firm. So it really helps you look at a business and evaluate, hey, what are the growth drivers here? What are those opportunities? Especially with private equity, it's cutting costs. It's trying to find new ways to grow revenues and pay down the debt that you're about to layer onto this thing. What are some synergies you can go get? And, how would I feel owning this thing if I couldn't trade it for 3 to 5 years? The way I can with public equities. So I know a lot of guys use the comment of, we do take a private equity approach to the public markets. But I really do think that thinking like an owner helps you find good ideas and helps you avoid buying stuff that, you don't want to be holding over the medium, the longer term if it's not working for you right away.
Yeah, and it's to your point about thinking like an owner, you can't be a real long-term investor unless you think like an owner as opposed to all these options traders playing off of gamma squeezes, which have nothing to do with what the companies actually do.
No, and you can make money doing a lot of things. And I just have, you go look at what some of these large PE firms are doing and the way that they're able to consistently generate returns by going out and finding smaller, medium-sized businesses, buying them, growing them, selling them. It's been a very profitable way to do things, and I think you can structure a fund to do the same.
On the just in terms of the background there, so on the private equity side, were there certain sectors or industry groups that you focused on, or was it much more
generalist? It was whatever our clients were going to look at. We did a lot of industrials, a lot of retail, a lot of health, and various things like that. But it was throw something at you and go look at it. I mean, there were some music royalties we got to work on. There's some fun stuff in there.
Anything of that side of your career that you missed?
Yeah, Access was really fun. You get to look at a lot of deals. And, you saw stuff that was going to be in the headlines weeks or months later when, some deals started coming across the radar. And so it was fun getting to work on that stuff and knowing that, you're going to see a byline about it pretty soon. So now it's trying to anticipate those things and, less of getting the peek behind the curtain when you're trying to keep yourself from getting locked up on public securities.
Yeah, no, I can imagine. Okay, now, so you had mentioned, Russell 2000 getting beaten up by tech. It's not just Russell 2000; it's everybody getting beaten up by tech. You can't. I think you're in this kind of one of those if you can't beat them, join them type of dynamics, right? Given the concentration of tech as a driver of what most people think is the market, but I argue is unequivocally not. Talk through to the audience how this tech momentum, just broadly speaking, has impacted sentiment towards small cap companies, and if there are certain industries that should you think get pulled higher by the AI?
That's a good question. So again, kind of going off of my approach, I really try to avoid getting too close to anything related to AI right now. I look at that as something where if you were able to see that coming 6 months or a year ago and get in front of it, you've done very well. My goal is trying to figure out things that are going to be more in the crosshairs down the road and getting in front of that demand. So I certainly think AI has a lot of applications. I think there's some really cool stuff coming in that direction. But I like valuing stuff where I'm able to put numbers around it and see more in the near term. If I'm trying to forecast cash flows 10 years out, I'm introducing a lot more execution risk than if I'm trying to forecast cash flows 6 months out. So it works great for growth investors. There are a lot of guys that are out there that are very good at identifying sector trends and where the money's going in tech. That's just not me. And so I try to avoid going out of my lane and buying stuff that, I don't have an edge in forecasting, where the AI application is going to be most relevant in 10 years from now.
Okay, so let's go with that point about forecasting from a very long-term perspective, because there is a narrative which is valid when you look at the number of companies that may not have enough cash flow to cover their interest expense. That there's a lot of in quotes zombie companies in the small cap and micro cap space, and right, and which I really want to hit on, because and where I'm going with this direction is I have to assume that forecastability now actually may be very, very challenged, because you are at this kind of a threshold where if the Fed were to keep on hiking rates, a lot of these companies really are going to go under. If they don't hike rates, then maybe there's some really interesting undervalued opportunities, because these companies would not just survive, but then start generating better profits. So talk about just sort of the confidence level of the future when there's debate about if rates go higher or lower here.
And that's one of the things that I really think is an opportunity here. Is there's lots of small caps, I think, that have gotten bucketed into the zombie company bucket that may not be as in quite as much danger as people think. So I think it's really important, if you're in small caps right now, that you're looking at, all right, how far out are these companies' debt maturities termed? Are they fixed? Are they floating? Have they hedged their interest rates? Are any short-term pressures on earnings more secular in nature, or is this a cyclical business that, a lot of these companies have had just wild swings in profitability in the last 3 years as they're dealing with headwinds from COVID and coming out of that in the new normal, versus things that, have reverted to the mean, and then, the bullwhip effect in retail. There's been some pretty crazy swings there. And so as you're starting to sort through who are the guys that are going to be okay, and who are the guys where their businesses got fundamentally disrupted and they're dead, I think that the market has thrown out some options that, were maybe perceived as being dead right now, but hey, it's a solid business underlying, some bad results, and there's a chance here to buy it, really make some money once the market finds out that they're not as dead as feared.
Right, but that's going to be the challenge. I mean, guys like you that do this for a living and are very fundamentally focused, where to turn to find out if there's hedges, if what percentage of liabilities of the debt is fixed versus floating, or whatever it be. I have to assume there's not like a centralized website that makes it easy to determine those types of dynamics.
No, and that's where being a fundamentally driven investor and getting into filings and actually going in and being able to peel back some of the layers here, it makes me think there's a real chance to get an edge here. And one of the reasons I set up my fund, I think that if I'm really willing to roll up my sleeves and dive into these things, I can find stuff that maybe other people haven't spent the time to realize it's not as impaired as the market is pricing it to, make it look like this thing is dead.
Are there, I'm sure you're looking at tons of different stocks. Are there certain subgroups or industries where there's a higher prevalence of zombie type companies, right? Where they're almost like could an entire subgroup or sub industry get taken out if rates get really crazy?
Well, I mean, that's a great question. So there was a lot of fear on that with banks here in the last few months. That how many of these small banks are structurally impaired for the long term? How many of them are just, dealing with some short-term headwinds? I have decided to try and stay out of the financial space for the most part. I don't think that's an area that I have a really good edge in. There's not a whole lot of private equity takeouts of banks, so I haven't spent much time on this. And I'm a believer that if that's an area you want to do well in, you probably needed to be up to speed on a lot of these companies before things got bad, because then it gives you a lot better chance to pick through which of these guys have good management teams, which ones are in the best financial shape, and kind of how much stress some of them can endure. So that's one area that I've looked at, and at least so far, I've just chosen to pass on most of those opportunities, because I don't feel like I have an edge on a lot of bank opportunities that get blown out. Another sector that's gotten beat up really badly has been retailers. And I think that's an area where I've spent more time, and I feel like I have the ability to go through some of these and find the ones that maybe are getting priced like they're going out of business, along with a lot of others. But not everything is Bed Bath & Beyond. They're not all going to file for bankruptcy in the next few months. but some of them are. And those are the ones you really gotta avoid. Bed Bath and Beyond was buying back shares a year ago, and they're bankrupt now. So, things can really turn on you in a heartbeat.
Okay, so that's actually that's a good area to go, because I've been noting that in my own research and in my feed. I mean, for all the talk around, we're in a expansion phase, we're going to avoid a recession. You look at something like the XRT, retailer ETF, which is largely equal weight against the S&P. It looks like a downtrend intact, right?
Yes.
It doesn't look like the participants in the retailer space are betting on consumer strength suddenly coming back in a big way. And again, that makes sense, right? Because of where interest rates are, credit card rates, things like that. But the fact that is not a concentrated type of proxy for the retail industry, I think, is intriguing as maybe a warning sign. But let's go with that. So when you look at the retailer space, first of all, why would you say that you have a bit of an edge when it comes to looking at small microcap type of retailers? And are you basically just looking at that from the standpoint of these are definitely going to go under and these are definitely going to survive? Or how do you go about trying to determine what's a buy and what's to avoid?
Sure. So one reason is because I've looked at them before. This isn't, with banks, would have been the first time I really rolled up my sleeves and dived into them. But coming out of COVID was one time where I spent a lot of time looking at retailers and trying to figure out, late in 2020, early 2021, that sector was really out of favor, and understandably so. And it was a perfect opportunity to be looking around and trying to figure out which of these things, had made the moves to be able to survive COVID and had an opportunity to really snap back as things got better during 2021. So I think that proving ground has showed there's a lot of these companies that really, did a good job pivoting to, more of a digital online environment. A lot of them had flexibility in their leases or have, strong consumer demand trends. But there's other ones that, weren't ready for that, don't have much of a digital presence, don't have flexibility on their lease space, and they've gotten blown out. So I feel like that's an area where you can sit down and you can, peel back the layers on these companies, and, they're not too hard to understand, and the risks are fairly straightforward. So, they're kind of simple, cash generating. You just got to figure out how much of the headwinds are temporary and how much of them are structurally impaired.
So I haven't gotten that granular on the space, but I gather that there's a pretty big difference between retailers that focus more on luxury high end versus everything else.
Yes. And that's another, really important point here is, as you're looking at some of these retailers, you've got to figure out who their consumer is. And it's a weird environment for that. You've got, higher end markets where, maybe you're catering to the ultra wealthy tech focused entrepreneur. And so as those guys were getting laid off last year, you go look at Restoration Hardware, they got hammered on their top line there for a little while. And, that's a very high end consumer focused business. And then you've got other, smaller retailers that maybe are focusing more your average American or someone that's lower income. And, those people got really hit hard by inflation, but at the same time now maybe, they're still employed. Unemployment hasn't spiked the way that many thought it would at this point. And, wages have actually come up a decent amount in the last year or two. So you're seeing, on one hand, you've got these pressures that are out there from inflation and from, student loans coming back online. But on the other hand, you don't have the 10% rampant unemployment that you had back in 2008. And so you can go back and see kind of how some of these businesses held up even with that. It gives you some confidence that, maybe their consumer is okay, or maybe not as dead as feared.
So I think that part about the student loan dynamic is interesting, but I'll revisit that. But the point about retailers, is there anything to the idea that when you're looking at the space, the geography matters, right? So if the retailer is more in the middle of the country versus coasts, right? Maybe they would fare better because there might be more consumer spending, in the middle of the country, whereas in cities there's a lot more higher cost of living. Is there any sort of geographic aspect to survivability in the retail space?
Yeah, no, there's definitely an aspect to that. And I'll use an example that's probably in the front of everyone's minds right now. So Kava came public yesterday, and you look at their numbers, they've been crushing it in the last couple of years. And, there's a company that, as they've been expanding their restaurant base, they've been very focused on the suburban locations, and they haven't tied themselves as much to kind of the 9-to-5 work crowd. So they've been doing a really good job of, benefiting from work from home trends because they're not concentrated on the office crowd buying their lunches there. Whereas you look at a peer, they have like Sweet Green, which is very focused on urban office locations. and their numbers just have not bounced back post-COVID the way that somewhere like Kava has because of where their consumer is, and kind of like you're saying, the lack of presence downtown and in these urban settings that was there pre-COVID.
All right, so let's keep going on this point about the student loan dynamic, because that is going to suck out some money flow, presumably, just a reallocation, not just by younger people, but by everybody, because as they keep noting, student loans aren't just for students. It persists obviously beyond that. But what's your sense? Is this going to be a bigger deal than most people are talking about in terms of how it might impact consumer spending at the margin? Or, is it just people are going to adapt and keep on releveraging like they seemingly always want?
Well, that is the $1 million question. I was looking at some analysis that Barclays put out earlier where they were trying to forecast this was going to be like a 15%, discretionary headwind to the population that still has student loans. But they're using assumptions that, okay, like a 6% average interest rate and 10-year average, payoff period. I mean, most people I'm talking to are looking at lower rates and longer periods than that. So I don't know. I have a hard time figuring out exactly how much that's going to impact some spending, how much people are already budgeting for that. People usually have the flexibility in their budgets to make room for something like that since they were paying it previously. I try not to read too much into future events. I mean, there's still time between when that resumes and opportunities for, different political maneuvering around that. So I try not to put all my eggs in one basket. I more try to buy stuff where I figure, hey, if they resume and spending drops by X, I'm going to be okay. It's the old margin of safety. Don't buy something that has a single point of failure that happens if one large event that's supposed to occur occurs.
So let's talk about some of those in the retailer space that you've been eyeing either as potential buys or that you already have in your fund that are interesting, unique, that nobody's really paying attention to.
So I'm going to give you two very different ones. We can talk about those for a bit. So one direct to consumer brand that I've got a lot of is A-Mark Precious Metals. It's a retailer of gold and silver bullion. So this is one where they're the only publicly traded company doing what they're doing, or anywhere near this scale. They're the largest U.S. wholesaler and retailer. So they've got a lot of market share and they're selling something pretty unique. So I've been involved with this thing since back in 2020. And it's been a 10-bagger since then. So that one's worked out pretty well. But I think it's still interesting in that, here's a business that's trading around an 800 million market cap today and has consistently done 200 million or so of EBITDA each of the last 3 years. So it's generated a ton of money. They've done a really good job deploying that and going out and buying these different retail businesses. And I know you've had some other conversations on here recently kind of talking about gold and silver and the price dynamics there. And what I like about A-Mark is you're not really buying this on the hopes that gold prices or silver prices go up. You're just buying it as, one, a play on demand for physical precious metals, and two, on volatility. And it seems like the one thing you can kind of count on in today's markets is volatility in commodities. And so as gold and silver prices whipsaw around, these guys make a spread on the gold and silver they're selling, and they've just been printing money as people buy bullion over bank fears and different worries out there in the market. So I like something that makes money off of fear, whether or not those fears become reality.
Yeah, and I got to assume that that's not sort of very heavily levered type of company.
Yeah, so it's one of those things, again, that you go screen it, and this is where, I like stuff like this, because you screen it and it looks like it has a lot of debt. And so people, might pull this up and be like, oh, I don't know how I feel about a, levered consumer business. Well, let's say, quarter to quarter, it fluctuates a lot because they have a big revolving credit facility they use to fund inventory. It's like $300 million, but they've got $900 million of inventory backing it. So optically, yes, it has debt, but they're also turning their inventory more than once a quarter. So it isn't like stale inventory you have to worry about, well, is the valuation good or not? It's gold and silver. It's got a price. They sell it regularly. It's, the debt is more than doubly back generally from what they've got on hand. So it's really just an inventory funding mechanism. So, sure, you can knock them for their debt, but they're going to credit them for their inventory that's, worth almost $1 billion.
You mentioned, I think there's another one. There are two that you mentioned.
Yeah. So very different space. I've got some shares in Children's Place right now, which is a small toddlers, babies, kids apparel retailer. Now, apparel has not been the place to be. If you go look at a chart on Children's Place, this has not been the place to be for most of the last year. But what I think is interesting about these guys, they've got, along with so many other retailers on the street right now. They've got this guidance that says, hey, things are going to get better in the second half. And you got people out here saying, well, I don't know about that. Second half, there's some consumer weakness out there. We don't really know if demand is going to pick up. Well, these guys had two specific headwinds that most other companies in their space did not deal with. And that's specifically with the price of cotton and freight. And so if you look at their results last year and just back out those two impacts, I mean, cotton tripled off its bottom from COVID. I mean, you're well familiar with how crazy freight rates got as all the supply chain bottlenecks happened in 2021 into 2022. These guys were paying top dollar for inventory between the elevated price of cotton and getting it here. I mean, they were paying for air freight to get stuff over because container ships were so backed up. Well, fast forward, demand starts to fall off right about the time that all their expensive inventory is hitting the shelves. And so the margins just take a huge hit. People are looking at this thing and thinking, oh, they're heavily discounting. Their margins aren't what they used to be. This thing's dead. It's got some debt. But if you can go through and just back out how much the impact of cotton and freight has been every quarter since all this stuff started going sideways, they've pretty much held gross margins at their historic 35% level. And they've run up some short-term debt, and it's all working capital related. And so you can go and take their guidance down for the second half and still have them generating over $100 million of free cash flow. And this is a company that's trading at $250 million right now. You're looking at something where you don't need a whole lot to go right. You can believe some stuff can go wrong. And their headwind with, stuff like cotton and freight is something very measurable, trackable that some of these other retailers don't have. So you're not giving them as high of a hurdle to clear as you might be with some of these other guys that are just counting on consumers finally spending more money in the second half.
Okay, so outside of retailers, what other interesting groups are you focusing on that, again, people are not focusing too much themselves on?
Yeah, so I'm a glutton for punishment. So I own some energy stocks, which worked out great for me at the beginning of 2022 when everything went crazy after the Russian invasion of Ukraine. And has worked out much less great for me over the last 6 months or so. Prices have come off, but again, my approach here is to go find something where I feel like they've got good margin of safety. They're producing a product. They have a lot of cash. I'm not out buying oil producers where their break even is $100 a barrel and just really hoping that prices go crazy. It's you can be right doing that and make a bunch of money, but it's a good way to lose everything. So I've been out here. I own shares in an Oklahoma integrated exploration production company called Unit Corporation. These guys are sitting here with about a $500 million market cap. They've already paid out over $100 million of dividends just this year. One reason that I like them over some of the other energy companies is that they have a segment that does their drilling and their production side for oil and gas. And they also have a rigs business where they help other producers drill new wells. And so these things kind of offset each other in that, prices went up a lot for oil and gas and companies wanted to start drilling more. So the demand for units rigs went up. So now they're getting some really, really nice day rates on their rigs at the same time that prices for oil and gas have come off. And so that segment's kind of supporting their earnings. And presumably now rigs are starting to get laid down and those rates are going to start rolling off over a 6 to 12 month period as those contracts expire. And ideally, less drilling means that oil and gas prices will, come back up a little bit and they'll start making more from that side of the business. So for a small cap, there's not too many integrated ones like this. Usually you can go buy, pure play oil field services businesses, or you can go buy a pure play E&P. I like this one for being integrated and kind of having that, counter-cyclical offset where each side of the business kind of has its time to shine.
I'm curious, has it been surprising to you how energy has performed? I'd say something which is, I was just pulling it up now, and I granted this is a large cap comparison, but like if I look at the energy ETF XLE and divide it by the S&P 500, the ratio is back to basically the April level of last year, which is to me insane, right? That with all the narratives around the energy space being the leader in the next cycle, replacing tech, you've undone actually quite a bit of that outperformance that everyone was so hyped on.
Sure. And, a lot of that has been died. You go look at, what the price of oil has done, what the price of natural gas has done, you start getting a little bit more supply in the market and all of a sudden, $120 oil and $9 gas wasn't quite as much the new normal as some people thought. And so we're quick back to chasing the shiny objects in tech again. And look, commodity producers aren't historically the best business to be in if you're just trying to make a quick buck. But some of these guys over time have really done a good job creating capital. It's just you gotta make sure you know who you're rolling with on some of these companies. So I think look, part of the narrative was last year that Europe was going to freeze to death and that there was an energy shortage worldwide. And then hey, you didn't have a very cold winter and everyone did great. Storage filled up and we were good. Everyone was fine. So does that mean that can't happen? Well, we'll see. I try to avoid buying into one macro narrative that says, hey, Europe's going to freeze, therefore here's a stock to go buy. I think it's a lot more of, hey, you can see there's been some underinvestment in this space. You can go find well-capitalized companies that have the ability to earn a lot of cash, even at low prices, and you can do all right. And you don't need to completely commit yourself to one narrative about where prices are going to go going forward.
Yeah, it's funny. I remember seeing tons of people do Twitter Spaces where that was literally the bull case. It was just purely around, to your point, Europe is going to freeze to death. So it's just funny how these things get undone throughout time. In your experience looking at small caps now, year to date, do you find that there's a lot more opportunities than other times you've analyzed the space, or maybe more danger, just given, again, the kind of zombie company dynamics?
Yeah, I mean, the thing with small caps is there's always just a lot more specific company risk than if you're dealing with large caps. I mean, if you buy, use a simple example, you go buy Walmart, you're unlikely to have one event occur that completely ends the company the same way you are with a lot of small caps. I mean, you can buy into stuff that just has, you've got a company with one or two mines, or you've got a company with one specific vertical that, can get disrupted and you're left holding a donut. So I think you're always dealing with more company risk in that way. You can't always hedge it the way you might be able to with a larger company where, hey, you know what the biggest risk is, but there's at least a good way to go out and get some exposure to mitigate that. So I think there is a certain level you just have to live with. Like, bad things can happen in small caps, and you never really want to get concentrated in one or two of these things and just hope that everything works out okay. Because a lot of these companies will tell you more goes wrong than you usually plan for. But yeah, I think there's a lot of opportunity here. I think you go look at earnings multiples in small caps right now versus some of the larger indices. Things can look really attractive, and I think a lot of stuff that has gotten sold off has some opportunity. You just got to be really careful figuring out what earnings you're anchoring to, because some of these things are still working through just all the craziness post-COVID. And again, that's where I think digging in and being able to really understand some of these businesses gives you an edge over the market in the coming years, because some of them really do have some terminal value risk here. Like there's places like Bed Bath & Beyond again that just got disrupted in a hurry, and all of a sudden, once demand dropped for in person at their stores, I mean, we're seeing headlines about these guys cutting AC in order to save money. I mean, like, that went sideways really fast. And a few years ago, Bed Bath & Beyond was, that's maybe this thing doesn't have a reason to exist, but they were at least generating solid cash flow, and they went from that to zero in a couple of years. So you really do need to be watching out for stuff that's getting disrupted and doesn't really have maybe as long of a future as you hoped.
Well, and I think you said it correctly. I'm going to make the assumption that cash flow as a metric probably matters a hell of a lot more for small caps than large caps.
Yeah, and you're exactly right. And some of these things might screen right now as having no cash flow, and it's because their working capital just got abused in the last 12 months with inflation and the bullwhip effect. I was talking about with some of these retailers where they went and bought expensive inventory right as demand fell off. So you might see them as like, well, this thing's not generating cash. Like, well, what are they going to do in the next 12 months? What kind of visibility do they have into demand? How much are they going to be able to cycle inventory? Do they have levers they can pull? Some of these, tech companies were able to go lay off, 10,000 people in a very short time frame. They'd overhired and they had more people than they needed, and were able to cut costs. And you're seeing the results. They're slingshotting up again. And so there's small caps that can do the same thing. There's a lot of flexibility in that space, and so it's sorting through, figuring out which ones have that and which ones don't. Just going back to the Children's Place again, one of the reasons I like these guys. 75% of their store leases are under a 2-year term. And that's a very intentional choice they made before COVID to make sure they kept a lot of flexibility in their store base. And not a lot of retailers did that. And so one of the reasons I like these guys is they had the ability to action nearly half the leases in their portfolio from the beginning of 2019 until today and really reduce their footprint and move a lot of sales online. Not everybody got the chance to do that. So, you can go in and look at that and, figure out, hey, these guys were able to take out a ton of fixed costs and they don't need a lot to go right in order for, their digital revenue, which is now half the business, to really, support their company going forward. Not all these things are dead. Some of them certainly are, and we'll find out over the next few years, which ones had the secret sauce and which ones didn't. But I think you can find some that have really been abused in a way that the share price has gotten beat up a lot more than maybe it was warranted.
It reminds me of like one of the more recent seasons of Walking Dead, where they figured out they can walk among the zombies if they wore the carcasses. Right, it's kind of like that, I think, when it comes to some of these companies, right? It's they may look like zombies, but they're just really not, and they'll survive. Let's think through this from the perspective of portfolio construction for a bit. So you mentioned you've got a fund. Is it a private fund?
So yeah, separately managed accounts. So each of our clients is has their own account. They will log in every day and see what they own. Especially if getting started out, that's a really good way to keep some trust that people are able to come in and actually see what they're holding, and that's been the best way for us to launch.
Yeah, although I will say, just from experience, I mean, I've done the SMA world myself. It's too much visibility and transparency also makes people start to question your thought process and thinking, and they're not going to go to the same extent as you in the due diligence. So it ends up being this, I find, at least from my own days, kind of a constant battle of communication, right? Where they don't necessarily agree with why you bought XYZ stock, which from their very cursory look looks, not that great.
Sure. And there's always going to be some of that, but I think the way you communicate with your investors and the way that you do your research up front really does give you an opportunity to help them understand, like, hey, here's why we bought this, and here's what we're looking for, and it gives you a chance to find out, are you right or are you wrong? I don't think there's enough of that in the investing space where guys really go back and test. Hey, I said this was going to happen. Did it happen? Because if you've got LPs that you're communicating with, then you've got to actually, face the music sometimes about, hey, here's something I got wrong. I'm going to get stuff wrong, and I can tell them that. But what's going to be important is being able to admit that I was wrong, why I was wrong, and learn from it each time. And being right more often than I'm wrong is also going to really help. So, it's accountability, but I think investing generally needs more of that and not less. I mean, you and I have both seen plenty of people on Twitter that talk with a lot of authority and haven't been in an index in, decades. And at some point, you go out there and you see some people and it's like, you know what? You've said a lot of things that haven't happened. I see guys have been calling for crashes for 2 decades and they still have a following. It's like at some point, you can't just live betting on a crash. You've got to go invest in stuff. Crashes happen. It's good to think about what can happen in a downside environment. But, there is some accountability that's good of having transparency like that. Maybe I don't always love it, but it's good for me.
Okay, so obviously I get the focus and tilt towards small micro, but you said it correctly. It's you got to be careful with some of these things in terms of how they could play out. Do you tend to run more of a concentrated type of portfolio? 20, 30 stocks, or you go bigger than that?
A little smaller than that, actually. So my goal is to kind of be in the 15 to 20 position range. Kind of depends how I'm doing things at a given time. If I, sometimes I'll have one position, but it's got a couple different legs. So, there's some options or pair trade going on. But yeah, the idea is, probably have 5 or 6 positions that are around half the portfolio, and then another handful of things that are kind of smaller based on either their size or less confidence kind of in where that outcome is going. So position sizing is one of the things that I think is the most interesting way, to engage with people in investing, because it gets less focus than kind of just the actual stock picking side. But you can be right in the wrong direction, or get right small and wrong big, and your returns really suffer for it. So I think that's one of the more interesting things to think about here, and that's one of the areas I want to keep growing in the most, is really understanding how position sizing is playing into how my returns are working out. I think that's somewhere to be a continual learner.
Yeah, no, for sure. And how do you think about the sell discipline? Because if you're running a high conviction portfolio, a small number of stocks, right, you got to be careful, obviously, if something's going against you and it's already a large position.
Yeah, and that's a great point. So I think recently I heard there was a new book from Andy Duke that was out talking about kill criteria that I think does a really good job of discussing that very, very aspect. And so one of the things at Kingdom Capital we're really focused on doing is making sure we understand what would need to change for us to sell a position and what the potential outcomes are that would cause us to lose faith in our expected outcome. And so, we've got a list of things. It's like, all right, here's what each of these companies could do or things that could happen to them that would cause us to, pull the fire escape and get out of here. And I think there's another popular one I've seen around on Twitter is if you're going to panic, panic first. And so we want to make sure that we know why we would need to panic in each of our stocks. If something's going wrong, you don't want to be sitting around trying to figure out the potential impact after other people have. So, sometimes you find out about a new kill criteria that should have been on the list, but didn't make it in. But we try to make sure we understand what would cause us to sell our stocks before they happen to us and not end up, being reactionary to a situation.
So speaking of that, on the Twitter side, are you? Some people use Twitter as a sentiment tell, so they might have an investment thesis, believe in it, but they're using crowd mentality to determine better entry point, right? In positioning. I'm just curious, do you use FinTwit at all to try to looking at specific stocks that you're analyzing and say, okay, well, it looks like a lot of people are bearish. Is actually probably an added plus to go into it now, or is that not even a part of the thing?
I think Twitter can be good for that, specifically in getting people to help pressure test some of your ideas. You only follow a certain group of people on Twitter. And so the sentiment that you're getting exposed to is generally from people that are fairly like-minded because that's what you're most likely to follow. So I don't want to read into that too much because usually if I'm checking sentiment, it's going to be people that are thinking somewhat like I am, and that's why I follow them. But I do really like Twitter and other platforms for their ability to get feedback and get pushback on ideas. And I think that's where it can be most valuable. Because when you're engaging in a public debate on one of your stocks, it gives you a chance to hear someone else say, here's why I don't own this. And is that something you've thought about? Does this person have access to data that you don't have, or do they have experience you don't have, and can they help you understand, hey, here's why this idea is wrong? And sometimes that can be really useful. I've gotten helpful feedback on ideas that I was like, oh, that's that's something I hadn't considered, or that's something I hadn't seen. And then at other times you find out that there's really not much of an informed opposition out there, and that can be an opportunity to say, all right, these guys don't like my idea, but they don't like it from, it's not from a position of knowledge. It's just from, a drive-by looking at something that I think I understand better than they do. So it doesn't mean you're right, but at least gives you some confidence that people that dislike your position haven't really thought about it very hard.
Do you tactically play with cash levels, or are you always, pretty much fully invested?
We try to stay fully invested. I think we have gotten a little bit less focused that way now that you can get over 5% sitting in cash. I mean, that's something that hasn't been available for a very long time. So I think we're close to 20% cash right now as we've made some money on a few ideas and have been able to roll into cash as we get ready for a couple other things we're looking at. But overall, I don't really think that, getting uninvested in the market is long-term is a fantastic strategy. Cash can be great, but the time in the market is better than time in the market often ends up being true. And I don't want to get too cute.
Yeah, no, that's a fair point. What do you think people get wrong about small caps? It's interesting to me. If you look at the Russell 2000 against the S&P or the Dow, right, and you're pretty much back to like 1986, 87-ish type of levels. So, despite all the narratives around, small caps have drift, they tend to outperform large caps over time. The averages show that it's not the case. My only pushback against that is that's probably because a lot of small caps became large caps and got kicked out, right, from small cap averages, which I think is missed in that way of thinking about things. But what else do you think people get wrong about looking at smaller cap companies?
Yeah, so the danger when you go in to just buy something like the Russell, you say, oh, I want to get small cap exposure. I mean, there's a lot of stuff that got SPAC'd in the last few years or that came public. It's not a profitable business. It's not generating cash flow. And all of a sudden is dealing with cost of financing that is infinitely higher than what they were looking at 2 years ago. So I don't really want to own the Russell outright. As a small cap investor, I want to own stuff in the Russell that's getting treated the way some of those other, profitless, debt impaired companies are getting treated. But something that's not. I think that, broadly speaking, you can buy the Russell and time it well and get good returns. But I think you have to be careful assuming that everything in the Russell is cheap just because it looks cheap relative to historic valuations. I mean, some of the stuff in there is cheap because it's not a good business and it's going out of business. We get a Russell rebalance coming up here end of June, and there's a lot of stuff that's getting kicked out there, and that's an opportunity to say, hey, a lot of these things are terrible and probably shouldn't have been in it to begin with. And there's other things that got caught up in that and are getting sold off by different Russell tracking funds, and wow, it's down 50% in the last 6 months and the business hasn't changed. So maybe there's an opportunity there. But, for every one of those, there's a bunch that are bad investments. And again, that's where being a stock picker and having some time with these companies really can give you an edge in a way that, just buying the index or trying to assess something in a short time frame doesn't let you do.
I think this is kind of interesting dynamic as somebody who's also in the industry. You mentioned you're thinking about this from an owner's mindset, much more longer term. So you've done your due diligence, you've constructed your portfolios, but you're holding these things for the long term. So, I mean this in a very respectful way because I think it's just interesting. What do you do with your time, right? In other words, once you've kind of allocated and you've got your approach, right, in terms of the construction of the portfolios, if you're going to be a longer term player, obviously you want to keep in mind and be aware of what's going on day to day and week to week and month to month with what you already own. But presumably you're not going to necessarily flip the portfolio that often. So what else is being done in that time period?
Sure. That's a great question. So, there is just maintenance diligence on the stuff that we own or the stuff that we're looking at that you can just spend so much time on. Just there's different sites I'm checking for some of our companies, whether it's news aggregators or data streams that we're tracking to make sure that things are going according to plan. And I spend a lot of time looking at new ideas. As you mentioned, Twitter is a really good sounding board for hearing from other people, stuff they're invested in. And you can, pull some of those up and go through and start testing them against the stuff that you own and, start asking the question, why do I own X over Y? What are my key reasons? Is there something better in this space? Because I think, there's a temptation as a longer term investor to buy something and become married to it. And I don't want to marry my stocks. I want to be able to recognize when something better comes along and make a move, or at least be able to understand why I own one thing over another. And so I think that's really helped me in the past where there's been some things where a thesis started to drift or something started to change, kind of the kill criteria that we're talking about, or just a better opportunity in a space comes along and you can sit down and critically evaluate it and say, no, I should probably own that instead because it checks the boxes better than what I currently own.
Dave, for those that want to learn more about what you do and your thoughts on markets, obviously there's Twitter, but any other places that you point people towards?
Yeah, Twitter's I spend a lot of time hanging out on, so happy to chat with people there. Our website is kingdomcapitaladvisors.com. It's linked in our Twitter bio. And I hang out on a few other sites too. Microcap Club is one that I found very valuable, and for somebody that's investing in that space can be really good for people that are looking for an opportunity to be in a smaller focus group of investors. And then there's a lot of interpersonal, relationships. And over time, and I found a lot of good people through Twitter. I spent a lot of time on Seeking Alpha in my early days of investing, and I still publish on there some. So feel free to reach out on any of those platforms, and it'd be great to get to know some other people who kind of think the same way that you do and are looking for those same opportunities in small microcaps.
So yeah, a good place to wrap this Twitter space out, given that I have another call coming up in 10 minutes here. Everybody, please make sure you follow David. Again, this will be an edited podcast. Thanks, David. Appreciate it.
Thanks for your time, Michael. Really appreciate you having me on.
Cheers, everybody.